green across the board on this final trading day of the week. Tom, are you there?
Yeah, I'm here, Scott.
All right. It's good to see you, too. When you were on with us a month ago, you downgraded the financials. You double upgraded the FANG stocks. It was a great call. You're reversing it today. Why?
Thanks. Central to that view a month ago was the idea that consensus was expecting rates to push too high. In other words, we thought actual rates would undershoot. Had to do with the idea that inflation expectations were coming down and GDP growth wasn't necessarily accelerating. Now we've, I think, had a growth scare that really peaked yesterday. I think the headline might have been the Tokyo Olympics, but that really pushed the 10-year down to 1.25. And now we think the conditions are set for interest rates to shoot above consensus expectations. In other words, we think rates are drifting higher. That's going to lift basically the entire epicenter complex, which has moved in lockstep with interest rates.
Okay. So I hear you. Okay. The problem I have with this call today, Tom, is that you yourself say your conviction is only 60%. I'm wondering, why make a call like that and go public with it if your conviction is only 60%?
Yeah, that's correct. Number one, we can only be 100% sure in the rearview mirror. So I can only be 100% sure a month from now. But the reason we think 60% is a really good change is, number one, the 10-year yield did bounce off the 200-day. That was an important level to hold. Second, we're pretty confident that there's a lot of pent-up demand, revenge consumer spending, and CapEx, which means GDP growth will be strong. And we know the Fed's going to be supportive. So the idea now that people think rates could undershoot makes us think you want to counter trade that. And again, 60% is, I think, adequate to make a reversal. You're right. It's a big change to be based on only 60% knowledge. But, I didn't really want to wait any longer. We sent it out as an intraday because we just felt that was the moment to send out the notice.
OK, I understand. Better to be early, right? In your mind, I guess that's how you're thinking of it. You just said that there's a lot of consumer demand. You know what else there's a lot of, Tom? There's a lot of liquidity, right?
Yes.
So why?
Correct.
Why do you think rates are going to go up from here if they've come down so far from their peak?
Yeah, Scott, that's a great question. I think three things drive interest rate change. One is growth expectations versus consensus. And the second is inflation expectations versus consensus. And the third is sort of what you call like interest rate VIX, the risk of future changes. And I think that there has been a fall in the 5-year break-evens, which is why inflation expectations come down, but that's stabilized. I actually think it could start to rise because, again, there is all that liquidity you're talking about. And on the GDP side, even though we've got the Delta variant and people think that poses growth risk, that's what I think is getting priced in now. So I think once we're through the Delta variant scare, which could take several weeks, growth expectations will actually be edging up, and that should push rates higher. So you're right. I think there's a lot of liquidity, but it may go more into equities because it has been really scary to watch the 10-year fall to 1.25. I mean, it's been disturbing.
It has. I'm just wondering if you look at let's just say the market action today specifically, I'm kind of hard pressed to believe that this tech move that we've seen in the last few weeks is going to reverse itself anytime soon and all of a sudden go back into the epicenter names, right? Once these big FANG Plus stocks have gotten a bid, I mean, the trend is your friend, and there is momentum behind a lot of these names. Apple being the latest stock in that group to hit a new high, which it just did today. You know yourself, once these things get going a bit, it's hard to break that track.
Correct. I'm with you on that, Scott. I think FANG is going to detach itself from interest rates, meaning they're going to have a great second half, not because rates are going to fall, but because these are great companies that almost did nothing in the first half. So we think if the S&P ends the year up 25, and a lot of these FANGs are up 5-6%, they could be up 20% in the second half. That makes them an overweight. That's why we still want to own FANG, even though we think there's an explosive rally in epicenter coming.